There we go. Alrighty, everybody. Well, we are at 11 on the dot, so I am going to get started. Thank you so much for all being here and expressing your interest as well as support in our ongoing webinar series that we've been doing. So this month, it's getting cozy outside with the color change and the 40-degree temperatures. So this month, we're going to be covering common money mistakes. So there's about 52 different ones that we're going to go through in sort of rapid succession. This is a little bit different of a presentation compared to some of the other ones that we've been doing. But, I've been a financial planner now for 8 years. So I've seen a lot of, people doing things well and unfortunately people doing things not so well. So this whole presentation is kind of a culmination of the different things that I'm seeing, people kind of goof up with. So some of it, of course, it's going to be very obvious to many of you, but truthfully, some of it is not going to be. And I feel that, just the more information that you have to make proactive financial decisions, the better. So that's why we do these for folks over, at Aurora, over at Children's Hospital. We're just trying to add some value for you guys. So common money mistakes, let's kind of jump into it. Before we get there, let's kind of just talk about what we're doing. And, I forgot my bio slide on this one. Oops. Well, hopefully you all know me by now. Well, first of all, I am not a CPA, nor am I an attorney. So everything that we're talking about today is just meant to be viewed as general in nature. So just keep in mind that, let me, for some reason. All right. So anyway, this whole presentation has been an ongoing series that we've been doing on this concept of financial well-being. So what is financial well-being? We kind of break it up into these 4 main categories here. So first of all is having control over kind of our day-to-day or our month-to-month finances. I'm going to hit on all these in the money mistakes, so I don't want to lose my thunder, but basically that one's having a budget, right? The second kind of pillar of financial well-being here is having the capacity to absorb financial shock. In short, that's having an emergency fund or a contingency plan. Thirdly, of course, being on track to meet our financial goals. Well, you got to have them to meet them, right? And then fourth pillar here is having the financial freedom that allow you to make the choices that you can live the life that you want to live. So realistically, this is kind of just encompassing all of them, but by being financially well, you can feel confident in spending your money. Financial well-being is not about saving every penny you earn, being super frugal, et cetera, et cetera. It's having goals, knowing you're on track for those goals, so you can be confident in spending your money, right? So let's kind of keep going here. Our agenda for today, right? So we kind of organized the different mistakes that are out there into these 4 main categories, right? So first of all, managing our finances. Second of all, avoiding or dealing with financial setbacks. Thirdly, meeting financial goals. And then finally, of course, making financial decisions. So keep in mind that these categories are not some end all, be all. In fact, realistically, many of these mistakes are going to kind of cross over into the different 4 categories. So we simply just tried to organize things to help you better understand where a certain mistake might fit. But in reality, it's not an end all, be all. So like I said initially, we're going to try to cover 52 different common money mistakes that I'm seeing as a practitioner. Me and my team, we're overseeing about $250 million. So I'm regularly meeting with people of all income levels, from people just graduating college, getting started in their career, to, people getting ready to retire, to people planning their estate because they know they have a limited number of days. So these mistakes may be not applicable to you, but a lot of them are applicable to most people. So our date today is simply to identify some of the potential pitfalls that are out there that you might come across in the future, so you can at least have them in the back of your mind, so you can confidently navigate whatever financial landscape you're going to be going through. All right. So without further ado, why don't we jump into these? So I made a point, and I already talked about it, is the first like financial mistake that I see a lot of people making is not having some kind of budget, right? So it's very obvious, but without a budget, you're never really going to have a good idea about not only where you're spending your money, but why you're spending it. So basically, all of the 51 other mistakes that we're going to be covering today, you can find a good rooting in not having some kind of budget. Now, we do actually an entire presentation on budgeting. If you need a recording of that one, just shoot me an email after this presentation or do it right now so you don't forget. We spend an entire hour talking about budgeting. We have a lot of good exercises and templates that people can use to help understanding, okay, well, what's coming in to the household, what's going out, and where is it going? So by having an understanding of your cash flow, that's just the framework for all financial planning, okay? So money mistake number 2, of course, is spending more than you make. Well, if you don't really know what you make, it's really hard to not spend more than it, especially nowadays where everybody has that magic little card in their pocket that allows you to always be able to purchase something, whether or not you have the money. So, anytime we're using a credit card or carrying that debt forward, we're in effect spending more than we make. So the only way that we can make sure this is not happening to you is to have a budget and stick to it. All right, the third money mistake that we're seeing out here is always buying new. I'm seeing a lot of this, it's kind of that keeping up with the Joneses mentality. Now, there's nothing wrong with buying something new, just to be clear, but there's also nothing wrong with buying something used. Just know the pros and cons of each. Buying new isn't always the only option. So look at your budget for guidance, really understand what you can afford. Don't buy new just to buy new, right? So I'm seeing a lot of people buy used cars nowadays. I'm seeing a lot more people thrifting versus buying, from a clothing department store. And honestly, you can get some really good deals, especially if you go to a kind of a more bougie area. I think this sweater was supposed to be $400 if I bought it off the rack, but I got it for like 30. Don't tell anybody that. Maybe I shouldn't have said that, but I practice what I preach. All right. And then of course the fourth one here. So not understanding wants and our needs. If you have children and you've dealt with them, you probably have heard that over and over and over is I want, wah, wah, wah. Well, guess what? Adults can be the same way. So we might diplomatically explain to a child the difference between a want and a need, but oftentimes we're really not listening to our own advice. So for example, we can take it back kind of over here to number 3. You may want a new car, but you may only need a used car. So you really got to find some kind of balance and really be realistic and responsible when it comes to financial decisions, right? So continuing onward, misjudging big expenses. I see this one all the time, especially, we can stick to that used car example here, is someone buys a new car and then all of a sudden they're shocked to discover, oh, not only did my car payment become what it is, but I forgot the idea that my insurance now is 3 times as much. Or same with when you buy a home and, it's advertised as move-in ready or an apartment. But in addition, you gotta pay for additional insurance on the home. Now you have a new set of property taxes. Most financial decisions that you're gonna be making in your life are not isolated. They have impacts and ripples on these different things when it comes to a cost perspective. So it's really important that you kind of zoom out and you get away from like just being in that buyer frenzy and think about, okay, I'm going to be doing this. What does that actually mean? Right? So the 6th one, failing to negotiate. Now, not everything's going to be negotiable in the financial world, but many things actually are. Okay. And you're never going to know unless you try. So, next time you're calling the cable company about an issue, see if you can try negotiating to get a month free. A lot of them, you'd be surprised at how much they're willing to wiggle around with a lot of these different bills and costs until you start pushing some buttons. For example, I I think everybody, when they buy a vehicle, you know, you get the 1 month free of Sirius XM radio. So of course I did that, and then I did not want to renew it because I have Spotify, right? I don't need to pay $25 a month for Sirius XM. But you know, then when you don't renew it, they start reaching out to you and they're like, "Hey, we'll give you another month free, or 3 months free, or do you just want a whole year for free?" So a lot of these things, you know, there's a lot of wiggle room with negotiation. Same with purchasing a vehicle. You know, you can usually get the salesperson to go down X, Y, and Z amounts. Same with, say, you're working with a financial advisor and you say, "Hey, your fee's kind of high." You'd be surprised at how many of them will be like, "Well, I can make it lower if you want to work with me." So don't do that to me though. Not taking discounts. So another one, number 7 here. The most obvious discount available to you is coupons, right? So also thinking about loyalty programs that are offered there by stores. That's a very popular one. I know, like here in Wisconsin, where I am, you know, I'm signed up for the Quick Trip Rewards program. And I feel like every couple times I go there, they're like, "Hey, you got a free coffee or a little free muffin." So it's those little things like that. I know it's not this substantial thing, but when you look at your finances, realistically, everything adds up. So a lot of times you can get discounts just by clicking links when you're online shopping or signing up for their email and then unsubscribing. There's a lot of different ways to kind of save money. So, you know, you really usually don't have anything to lose. There's just gains with it. So unnecessary fees, number 8. I see this one all the time with a lot of different things. So whether it's shipping and handling, whether it's processing fees, you know, the list kind of goes on and on and on. Some of them are completely avoidable. You know, I always make the joke when, you know, I'm buying a concert ticket or a plane ticket and there's like 5 other fees outside of the concert ticket itself. You know, sometimes you can't avoid them, but a lot of times if you can identify certain ones, you going back to our number 6, that negotiation, some things are negotiable, especially when it's shipping and handling. I think that this one's really important, the unnecessary fees when it comes to bigger purchases. So like purchasing furniture for your home or like vehicles. I've seen people like car companies try to charge like $1,000+ for a delivery fee. And you could just be like, "Well, I'm not going to buy the car if you charge that." And they'll be like, "Then we're not going to charge you for it." So a lot of this stuff is just having an awareness of what's going on financially when you're making these transactions. And really looking at, you know, the fine print, which I think is one of the ladder money mistakes here too. Number 9, moving on. Here, let me get a sip of water. This is a hardcore talking one. So not knowing our slow leaks when it comes to finances. So this is a really important mistake to kind of keep in mind here. There is an old saying that, you know, even the smallest leak can sink the biggest ship. I just realized, is my picture over here? Can you guys even see me? Hopefully now you can. Sorry, I got distracted. You know, knowing that the small leak can sink the biggest ship. The same idea goes when it comes to your finances. So if you're leaking small amounts of money here and there, you know, like a coffee before work and a protein shake after work, you don't realize how much that starts to add up. Like you don't feel it when it's happening, but it can grow into a bigger and bigger problem at the end of the month. So sometimes for that example that I used, you know, like I've met with people who every day on their way to work, they spend $4 or $5 at Starbucks. And then every day after work, they go to the gym and then they pay $7 or $8 for a protein shake smoothie. You know, that really, really adds up. That $10+ a day, that ends up being $300 to $400 over the course of the month. And, you know, it's pretty easily avoidable. Once again, I'm not saying that you can't treat yourself. Once again, I'm not saying that you can't spend your own money, but it's just very important that you're kind of identifying these things. Another small leak that I feel that I commonly see with people is, what was I going to say? Oh, subscriptions. Yeah, subscriptions is a big one. You know, I think I see people being subscribed to gyms that they haven't gone to in months, apps that they don't use anymore. You know, like I'm guilty of this too. I have Audible and I haven't used it in like 4 months, but I'm keep paying for a credit every month. You know, there's a lot of stuff like that. And like I said, it's a slow leak. When you really magnify 10, 20, $30 even over the course of the year, that's $300. $300, not something to scoff at, right? Forgetting about our irregular expenses. So this is another one that I see a lot of the time too. I got okay. Needless to say, I'm seeing a lot of these irregular expenses not being counted for in the budget. And what I mean by that is we're all certain that there's monthly bills that we're going to have to experience on a month-to-month basis that we can budget for. However, some of them are a little more spaced out, but we still kind of should be expecting them. So, for example, oil changes, a lot of people don't really think about that because it's not every single month. Or same with like changing your vehicle tires. Typically it's, every XYZ, or even furnaces. So I have some people, when we're living really tight budget wise, where we'll kind of budget out, hey, your home's furnace is probably going to last another 5 years. Should we start setting aside $20 a month for when we know within reason it's going to be replaced, right? So some of those things that a lot of people often overlook when they're budgeting, because they're trying to think in a month-to-month basis, when in reality there are reoccurring expenses. They're just a little more, staggered out. Number 11, spending frivolously. I think everyone already knows this, but we just don't listen all the time, and it's really hard. It's part of being human. You trade all your time for your money, right? You want to treat yourself, and I think you can. You just have to operate within reason, of course, of your budget, right? So it's pretty self-explanatory. We just kind of need to balance the wants and the needs deal a little bit better, right? Number 12, having too many never-ending payments. This kind of goes with the slow leak thing. You can think of your phone bill, your cable bill, your electric bill. These payments, they never stop, and they usually never go down. If anything, they go up over time. Many of these are necessities, so we have to have them, but some mistakes get made when, we're accepting these reoccurring payments as routine, and we start to lose sight of what we're really paying for. And, what we mean by that is when we become comfortable with taking these never-ending payments, we can often fall trap of taking on more and more and more of them. I see a lot of people doing this with like grown-up toys. And what I mean by that, keeping it PG, is buying like an ATV, and then buying a boat, and then buying a jet ski, and then buying a this, and then buying a that. It's really easy to be like, oh, that's only an extra $100. Oh, that's only an extra $150. But then you really start to look up at some of these things, and you're roped into these. I get that some of them aren't never ending, but like for another 10 or 15 years, you're putting extra more and more and more stress on your budget, which isn't always good. Having free cash flow is good. Going back to what I was saying before, you can't always afford it. Let me get some water. Like I said, this is a big talking one for me, so I'm going to need some breaks. Bear with me. Number 13, not paying attention to interest rates. This has been a huge one over the past couple years because interest rates have spiked so much. So, oftentimes with number 13, we see this in number 14. So I'll kind of talk to them in general, but not really understanding, what's going on with the interest rates, with the payments on your statements. A lot of times people might miss a payment by a couple days and end up having to pay extra. So oftentimes you're really not going to know what's happening in your finances unless you're reviewing those monthly statements that your credit card company is sending you, your mortgage company is sending you, your student loan provider is sending you. With all these credit cards, if you're missing payments, your interest rate can increase permanently. You can get late penalties. Chances are you might, end up paying a lot more than you realize. And they're just trying, these credit card companies and a lot of debtors, they love trying to keep people stuck in debt, unfortunately. So it's really good to just look at the statement. You don't need to spend an hour reviewing it. It's just a quick glance. But even too, some of them will show you, I do a lot of work with people who are in credit card debt, right? And, a lot of times they'll show you, hey, if you make only your minimum payment on this debt, you're going to be in debt for the next 30 years. But a lot of people don't see that. And they're like, oh, I only need to pay $25. Sure, I'll do that. And then, you fast forward and those people keep spending on that card. And then all of a sudden they just get into a situation that, I don't wish on my worst enemies, but a lot of us find ourselves pretty deep in debt sometimes, right? So like I said, number 15, missing payments. Missing payments, as we just mentioned, it can lead to higher interest rates and late penalty fees. It'll most likely have a negative impact on your credit score. So even if you can only afford the minimum, really try not to miss a payment. I have this as a later money mistake, but I'll say it now. It's very good to have credit cards on auto pay, even if you're just doing the minimums for auto pay, just to ensure that you don't miss those payments. You know, sometimes you're on vacation, sometimes you just life gets away from you and it gets a little too chaotic to keep track of those one extra little things. So it's really good to do that just so you ensure that you're not hurting your credit, you're not ratcheting up higher interest rates and, you know, these expenses, which, you know, I almost think of those late payment penalties as like speeding tickets, or it's like, man, like I really didn't need to spend that extra money there, but now it just went down the drain for something I totally could have avoided, right? Number 16, I see this one a lot too, is overspending on gifts. You know, I'm guilty of this one. I had 7 weddings this year, and I don't know if I'm ever going to financially recover. Just kidding. This is also, you know, called keeping up with the Joneses, right? Or keeping up with our family. So we often feel pressured to give gifts of certain monetary value. You know, if you look up on the internet, how much should I give on a wedding or something, like give what you can, give what's reasonable. You know, it sounds cliche, but it really is just the thought that counts, and your presence is the present, right? So many of us are overspending on gifts. Think about last year's holiday. That's why Christmas is always so stressful for people, because they feel like they have to give everybody a gift, and it has to be like a really good gift. It can't be like handmade or something from the dollar store. So, you know, it's better to just play on the safe side. It's the thought that counts. So when it comes to gifts, give from the heart, don't give from the wallet, right? For some reason my arrow keys aren't letting me. All right, so number 17 here. Not having an emergency fund. So now notice too, we're transitioning from blue, which is, you know, the money mistakes. Now we're going to mitigating financial setbacks. Okay, so the first one on that list, number 17, not having an emergency fund. This is almost always a critical mistake, and that's why we have it as our number 1 for this section. You know, part of it stems to not having a budget, but with this, everyone will at some point need to rely on an emergency fund, whether it's for a broken car, a new roof. It could be as serious as a disability that's, you know, keeping you out of work for a prolonged period of time, or just a company layoff, you know, like during COVID, what happened. Whatever the emergency fund is, you know, having a financial cushion in place to help you weather that storm is absolutely critical to your long-term financial health. So, you know, a lot of experts out there like Dave Ramsey and et cetera, they say that typically you should have like 3 to 4 months worth of your salary set aside in an emergency fund. So that might sound substantial to a lot of people, because honestly it is. But even too, like there's studies that are out there that say that over half of US citizens do not have in excess of $500 set aside that they do not touch as a reoccurring month-to-month thing. It's really important that you have some kind of cushion, right? So number 18, only having one source of income. So first of all, just want to clarify, I'm not telling you to go out and get a second job, but having some kind of other sources of income coming into the household, no matter how small it is, can not only provide you with some additional funds every month, but more importantly, it can just help you meet ends meet for, you know, if something serious happens, like there's a loss of a job. So, you know, I know a lot of people will make money off of hobbies. I know a lot of people have rental properties, or they live off of like dividends from their life insurance policy or their investment portfolio. So it's good to have something that's not purely, hey, I'm relying on my job, my W-2 paycheck, right? Number 19, not understanding employer benefits. This is a massive one. Our team is doing a huge effort right now to help people during open enrollment. If you're from Advocate Aurora, I really would encourage you to reach out to me. We're doing, you know, free consults, because you guys are, what day is it today? I think you start open enrollment in 2 days, right? So oftentimes, financial setbacks are going to be occurring due to medical reasons, whether it's a serious illness or, something less serious yet still expensive, like a root canal or something like that. And we need to turn to our employee benefits for help. So all too often, we find that we're very unaware of the ins and the outs of our insurance coverages. We'll get through our employer and then we'll find out too late that some kind of procedure isn't covered, or we went to an out of plan provider. It's really important that you take the time to understand what your benefits are while you're healthy so you can make informed decisions. What providers to go to when you really need them the most, right? Number 20, carrying too much credit card debt. I'm sure all of you kind of expected this one to be on the list. This is one of those examples of a money mistake that can kind of fall into a lot of the different categories that we're talking about, but we put it here just for the simple reason that in an emergency situation, right, a financial setback, you may desperately need to rely on your credit card. Okay. And if you're carrying too much debt on your credit card already, your card could get declined. You might not have enough space on it, or your credit usage could go through the roof, putting your credit score down into the basement. Right. Number 21. I might need to speed up. Oh no, I think we're basically halfway done and I'm a half hour. So this is going to be an hour-long presentation, I think. Not having an income protection plan. So this is a big one for financial setbacks. A major financial setback can occur to you if you become too sick or too hurt to work for an extended period of time. So generally speaking, if you're becoming disabled, you risk losing both your job and your income. So just a moment ago, we kind of discussed taking time to understand what your employee benefits are. And a common benefit that may be available to you through your employer is group long-term disability coverage. This is a great benefit to take advantage of. Most people are usually automatically enrolled in it, but oftentimes, it's still not going to be enough. So typically what we're seeing is that those group benefit plans, they're going to cover about 50 to 60% of your income. So say you're making $100,000, you get disabled for, cancer for 1, 2, 3 years, right? Are you going to be able to sustain your household on 50 to 60% of that 100,000? Not to mention, since it's paid for by your employer, let's just call it 50. So that $50,000 that you would be receiving from the group disability plan, that benefit would actually be fully taxable to you at your tax rate. So usually we could say like 15 to 20%. So in reality, that 50% benefit is probably more like, I don't know, 35 or 40%. Okay. Number 22, not having enough life insurance. So this mistake can lead to some very major financial struggles and of course, lost opportunities, not for you, but more for the loved ones that you have down the road. Majority of Americans are underinsured. Are you? It's very important that you kind of know what would be appropriate for you and your family, whether you get it through work, whether you should look outside of work. Our team does a lot of help with this, especially during open enrollment. So if you want some kind of insurance analysis, just let me know. We do that at no cost, right? Number 3, having too much financial complexity. So this one's always goofy to me, but I see it a lot of times. If you need a PhD in economics to understand your own personal finances, it's going to be way too complicated for you. And what I see the most of with this is usually say a married couple, right? Spouse. One of the spouses will kind of be the person to do everything, know where everything is, et cetera, et cetera. Unfortunately, down the road, if something happens to that spouse, the survivor or the capable one in the case of incapacity is going to be left with everything. They're not going to know where anything is. They're not going to know how everything works. They're not going to know why, what is set up, who, and it just gets confusing. I've had a lot of widows come into my office with a box of stuff in tears after their spouse passed away and be like, Lucas, I have no idea what we have. And, it is what it is. So it's important to kind of simplify, keep it simple. By doing that, your room for error is kind of a lot bigger. So 24, making rush decisions. This is something that we see a lot of too. When it comes to your finances, never rush any kind of decision that you need to make, and never let anybody make you feel rushed to make a decision, whether it's purchasing a car, hiring a CPA or a financial advisor. All of these people should respect that any decision that you make regarding your finances is, first of all, your decision. And second of all, it's a big decision. And sometimes these decisions are permanent. Same with like starting Social Security, or choosing to retire, or backing off to work part-time. All of these things, you shouldn't take them lightly. You should have a plan in place and really try to plan months, if not years, in advance. All right, so let's kind of transition here. Now we're going orange, right? So staying on track. Number 25, and our first one for staying on track in financial mistakes that we can make. Not having financial goals, similar to like the budgeting and some of the other topics that I've hit on already today. Not having financial goals and financial goal setting is a whole presentation that we do. If you want a recording of that, please email me and I can get that over to you. But here's another very critical mistake that we see a lot of people make, is without financial goals, you'll never know if you're on track to building your savings, planning, or going towards retirement, paying down debt in the way that you want to, because without goals, realistically, you're flying blind, and you can't make future financial decisions unless you know the trajectory that they're putting at you on. So having financial goals is extremely important. It's a drastic mistake if you do not have them or do not make any kind of attempt to formulate them. If you need help setting financial goals, let me know. Not saving for the future. I think this is a no-brainer, but I see it all the time. I see, a lot of people living that YOLO life, you only live once, spend all your money, savings for the birds kind of thing. Many of us are living paycheck to paycheck, which I understand that makes it very difficult to save. However, saving is very important for your financial future. You should try to have some kind of savings goal in your monthly budget. And if you can, eliminate and reduce expenses wherever you can in favor of saving, especially if you're doing nothing. I always tell people, at a minimum, and I'm pretty sure, yeah, this is number 28, at a minimum, you should be taking advantage of your employer's retirement account match. I'll talk about it in a second. Not automating savings. Number 27, I see this as a big one, and I see this as very, very beneficial if people start it. So one key to saving regularly is just to automate the saving process. So for example, having a small amount of your paycheck each week, or each bi-weekly pay period, however you're paid, and it directly gets deposited into a separate account. It automatically does it, out of sight, out of mind. You don't need to manually go in every month and be like, all right, I need to put $150 into my high yield savings account, because then you're actually putting attention to it and being like, but I could use that $150. So, when you're automating the savings, it's just one less thing to think about. And then you don't need to kind of ask yourself for it all the time. It's a built-in discipline, and you'll never regret doing it. Especially when you do it for a couple of years and you look back at it, be like, wow, there's a couple $1,000s in here now. It's very, very helpful. Number 28, money mistakes. Not taking advantage of your employer's retirement account match. This is a huge one. In my opinion, and many people's opinions, it's free money, right? There's no place where you can put $1 and automatically just get $1 back, right? It's 100% rate of return if you think about it that way. So this is a huge mistake I see a lot of people making. Whatever percentage your employer says that they will match you in a contribution for your retirement account, try to make that your minimum, right? That'll be the minimum that you contribute. If you contribute more, that's great, but take every penny that your employer is offering you. Don't leave it on the table. That is an employee benefit, and it's something that I often see as a very overlooked one. Say your match is 4% and you're only putting 2% in. That's 2% of your salary, in essence, as a bonus that you're just kind of leaving on the table. All right, number 29, having a short-term outlook. So when it comes to finances, you do need, admittedly, both a long-term outlook and a short-term outlook, right? Keeping your eye on the short term is important, but it shouldn't be your only focus, okay? So long-term planning is critical to success when it comes to finances. So saving for retirement, paying down debt, we want to think of those as long-term goals, not short-term. And I find that the longer term that you stretch some of the stuff out, the easier it gets. I think about paying down debt as a big one. I've been dealing with that a lot with certain clients is, they'll look at it and see the bill that they get every month, or they look at it and they see the total amount that they owe in aggregate. And it's very, very overwhelming to a lot of people. But if we really scope it out and look and say, hey, as long as you keep doing this for 7 years, it'll be gone. It gives you a lot more peace of mind than looking at today and seeing $20,000 as this big mountain. We need to make molehills out of our mountains, right? So number 30, not changing with the time. So change is inevitable. And of course, especially with today's technology, change seems to happen on a daily basis, right? So most importantly, you and your loved ones need change too. So your financial priorities should change when you do. So flexibility in your finances is just going to give you the ability to make these changes as they come up, right? So number 31, paying the wrong debts first. I see this a lot. As I said, I do a lot of work with helping people plan for debt repayments, telling them what ones to focus on first. There's a lot of methodology behind this, but oftentimes the largest debt you have isn't always the best debt to pay down first. Sometimes it's better to, pay off debts that have the most potential to negatively impact your credit rating and your overall health first. So sometimes that smaller one, so the credit reporting bureaus can see that you reduced, when they run your score, they'll say, oh, Joe Schmo has 11 different sources of debt. That looks bad. But if you pay off some of these really small ones, then all of a sudden it drops to 7 and it looks really good. And that same amount of money you could have thrown at a big one and still been at 11 debts total. So there's a lot of structuring that we can do with debt repayment to improve your credit and, of course, get you out of debt faster, usually together. So if you have questions with that, if you need help, let me know. Number 32, prolonging debt repayment time. There's many reasons why somebody might want to extend how long they're carrying debt for. Sometimes a tax deduction can be one, right? But oftentimes we kind of get into the habit of just paying off the minimum every month. And of course, this can result in substantial future payments in just interest only, right? So if we're not being advantageous with how we're paying off these debts, it can get really messy for you. So just really understand, what you're doing and how long it's going to make your debt payment. All right. Number 33. So borrowing from retirement accounts. Give me 1 second here. I see this a lot, or I see people at least thinking about doing it a lot. Borrowing from your retirement account, such as a 401k, it can definitely help you pay for a large purchase, like a down payment on your home and, et cetera. But there's a couple things to think about when we're doing this. So, and I'm speaking specifically about taking a loan, not taking a distribution. Both are kind of not advantageous. So if you take a distribution from your retirement account, and you're less than the age of 59 and a half, you have to pay a 10% penalty plus taxes. So usually it's not advantageous. Still, people need to do it sometimes, right? But taking loans, I think, is almost worse. So let me kind of break down how taking a 401k loan works and why it's not in your best interest most of the time. Okay, so the amount that are in your retirement account, of course, they're going down, right? When you're taking out a loan, meaning any growth that's occurring is going to happen at a slower pace. Okay, so first of all, it's reducing your growth. Second of all, when you need to repay it, you're in essence paying taxes on that money twice. Okay, so think about that for a second, right? When you need to repay the loan from your 401k balance, you need to repay that loan with money from your current income, which is taxed. Then, when you pay that loan back and you want access to that money back in retirement, you have to pay taxes again on those distributions. So you should also be aware that if you stop repaying the loan and it goes into default and the balance owed becomes the taxable distribution subject to taxes. So for 401k loans, they're a tool. I really don't recommend them unless it's like a means of last resort, because it's one of the most inefficient ways for you to have access to your money or just to money in general. Okay. Number 34, not understanding the costs of retirement. So this is kind of down the road, but it's important that everybody knows these. It's important that you start creating a retirement budget and ensure that you have both savings and income in retirement to cover those expenses. Okay, so we want to consider all the costs that you'll face. So, for example, you may now be on a different health insurance than when you were working, and how your taxes are going to work. There's a lot of changes that go into retirement planning. When I'm working with clients from a retirement planning standpoint, I usually have them start piecing together two budgets, right? Your budget for today while you're a worker bee, and then your budget for tomorrow when you're a retired, I don't know what animal, a retired person. So 35, not having any kind of distribution strategy. This is a huge one that I'm seeing with retirement. A lot of people think about retirement as, how can I get my 401k to be as big as possible? Now, there's nothing wrong with that at all. However, entering retirement without some kind of well thought out strategy for how you're going to turn your retirement funds into income is a huge, huge, huge money mistake that we see. So it may put you in a position where, you're withdrawing your assets too quickly. You're getting wrecked by taxes. There's a lot of planning that should go into that. If you need help with that, that actually is my specialty. So please let me know. Take advantage of the free consults that we do for folks. Not understanding Social Security is another huge one. Many of us, Social Security is going to make up in a very, very, very important and large part of our retirement income strategy. So questions you may have about when we should start collecting benefits. Can I start benefits while I'm working? How does it work if I pass away? Or, hey, my spouse never worked, I was always the breadwinner. Social Security does not have a one-size-fits-all program. It's a very unique and personalized to your household and your situation. So it's very important that you work with somebody who knows the ins and outs of Social Security, like me, who can help you understand what your options are and how best to maximize those benefits that you've been paying for your whole life. Okay. Now we're going to transition. I think this is our last section, to the making decision part. Okay. First money mistake in the making decisions is not talking about your finances. Open communication is a key to having a successful financial life and financial future. Unfortunately, many of us do not like talking to each other or our spouses or professionals about their money issues on a semi-regular basis. And this can lead to you digging yourself into a hole or going down a direction that you may not have understood the repercussions of. So it's very important that you're just open and honest about your finances, whether it's with friends that understand it, your partner, coworkers who are a little more financially literate, people who work at your 401k or your financial advisor or your accountant. Don't feel like you need to keep secrets from these people. Yeah, especially if it's a licensed professional, it's their job to help you. And we cannot help you if we don't know what you're doing. All right. Not getting professional advice is the next one. In addition to speaking with your partner about finances, it's very important that you seek out a financial professional for advice, whether it's a tax person, whether it's an investment person, whether it's an insurance person. Not only can that financial professional provide you with information and education that may not be readily available to you, they can also provide you with unbiased opinions about your finances that can help you detach from the emotional component of them. And I think that's the hardest part when it comes to our money, is the emotional component, right? 39, not being knowledgeable about it. Now, I'm not saying everybody needs to have, once again, a PhD in finances. There's a lot to know, and some of it's very complex and very confusing. But the good news is you don't have to know everything, right? Just know the basics. That'll get you 90% of the way you need to go. Honestly, know how to budget, know how to create a debt management plan, know the difference in investment types and the impact that interest can have on you. If you do these things at a minimum, you're going to be able to make some very good informed financial decision that it's just going to kind of put you in the driver's seat to your own financial situation. The 40th money mistake, waiting to get started. Here's another old saying, but the best time to plant a tree is 20 years ago. The second best time is, of course, today, right? So this sentiment applies very much to our finances. If you haven't started planning yet, don't worry about it. We do not need to wait any longer. There's a lot of resources available to you through work or externally through work. Don't keep putting it off. Okay. Number 41, not paying attention to your credit score. Okay. A credit score is a numerical representation of your credit worthiness. Ultimately, it kind of doesn't mean anything besides helping you get into more debt. But if you ever want to buy a house, if you ever want to buy a car, if you ever need to take out a loan, it's very, very important. So, a 2015 study found by the FTC found that 23% of consumers had inaccurate information on their credit reports. Think about that. Almost 1 in 4 people have a score that's being affected by something that shouldn't even be on there. Okay. So it's really important that at least every year you look at your credit score. I think you should do it every month, maybe every quarter, and just do it. You can get a free credit report and it doesn't impact your score, but it'll show you outstanding debts that you have. If you see one and you have no idea what it is, it's probably being inaccurately represented and dragging down your score. So get your credit score at least every year, monitor it for inaccuracies, and protect your score as best as you can. Okay. Number 42, not diversifying assets. Okay. Different investments react different during market fluctuations. So diversification can really help lower your investment risk by not having all your eggs in one basket. So, these index funds have been really popular. Mutual funds have been really popular. Not putting all of your savings into Tesla stock is kind of the example that we're trying to make here. Number 43, not having a will or an estate plan. I see this with almost every person I meet with because I usually ask about this. Do you have a will? Do you have a trust? Do you have powers of attorney in place? Most people don't. They're very important. At a minimum, you should have wills, powers of attorney, and beneficiaries on everything. So a will, of course, is just a written instruction to the executor of your estate saying, hey, this car goes to here, my parent goes here, this goes here, right? Powers of attorney is not on this, but it should be. Hugely important. Most of you work in the medical field, so you should know what they are, but I would not be surprised if more than 60% of you on this call do not have them. Okay. Power of attorney, at least in the state of Wisconsin, you can literally get them for free on the internet. You just need to have them notarized. I notarize them for free for people. I am a notary in the state of Wisconsin. I would really encourage you to get those. So basically what that means is if for some reason you are incapacitated and not able to, function, say you got in a bad accident, you're a vegetable, well, guess what? You still have bills. Guess what? You still need to make healthcare decisions. If you don't have a power of attorney, nobody can do that for you on your behalf, even a spouse, depending on how your bank's set up. Another thing when it comes to powers of attorney, before I move on, if you have children that just started college and they turned 18, become their power of attorney. It's hugely important. I've seen parents go through that where their kid unfortunately got in some kind of accident at school while they're away and their parent didn't get named as a power of attorney. You can't just call up a hospital and be like, what's wrong? They'll be like, well, are you your power of attorney? Like we can't release private medical information to you about an adult. So be put on as power of attorney. It's huge. Number 44, I see this one a lot too, having out-of-date beneficiaries. So we all over the years have identified beneficiaries on various documents such as wills, insurance policies, retirement accounts, bank accounts. Oftentimes we don't ever really go back and update them as life changes. Okay. So I see people get married. I see people get divorced. I see births and deaths of children. You should review your beneficiary. It only takes a couple seconds. Review your beneficiaries at least once a year. I've seen it happen where people have passed away and technically by the law of the state, accounts have had to go to ex-spouses or parents that they got estranged from, stuff like that. So it's very important that you know how your beneficiaries are set up on anything you own, just so you don't end up rolling over in your grave later. All right, hang on there, guys. We are almost done. Number 45, paying only the minimums on credit cards. We kind of talked about this at length already, but the minimum payment on our credit cards determined by each credit card individually. Every company is going to be different. So check your terms and conditions for how that works. But realistically, if you're only paying the minimum, they are going to keep you in that card for as long as possible and charge you boatloads upon boatloads of interest, right? 46, spending too much on housing. I see this a lot. It kind of goes back to the whole keeping up with the Joneses stuff, right? But whether you're buying, whether you're renting, oftentimes we're spending just too much on housing. I think this is a little skewed right now because the increase in the cost of living compared to the increase in our collective incomes has gotten really staggered. But a rule of thumb that's out there is that you should try to target your living expenses for basically just a roof over your head should be about 25% of your income. Now, of course, the real estate market, like I said, it's going to kind of have an impact on that. But bottom line, the higher you push that percentage up of your income for housing, the less money you're going to have to do absolutely anything else, including savings. So, I see a lot of people being house poor in today's world. It's not always the best place to be, right? 47, prioritizing mortgage over other debt. So when it comes to debt, there's good debts, there's bad debts, right? I would say good debt's more like a mortgage. I mean, if you read Rich Dad, Poor Dad, Robert Kiyosaki might disagree with me, but typically, if we're comparing a mortgage to a credit card, I'll see sometimes people will aggressively try to pay down their mortgage while they'll run high balances on credit cards. Well, your mortgage rate is usually only, depending on when you got it, let's just call it 3 to 7%, whereas your credit card's like 30. Okay. A mortgage is debt that you have, but it's slowly turning into an asset. Whereas credit card debt, it's literally just there and it weighs down your situation, right? So let's talk about why mortgage is good debt. Okay. The value of your home is likely going to increase over time. Number two, with that, the interest that you're paying on your mortgage does have tax advantages. Okay. So we do get a mortgage interest deduction when we file our taxes, especially if you're an itemizer. And with that, you can use your equity as collateral to take out home equity lines of credit, et cetera, et cetera. Like I said, a credit card's just dead weight. I would say if you're paying extra on your mortgage and running big credit cards, get rid of the credit cards first and then go do that. Okay. Prioritizing college funding over retirement. I see this one all the time. I am a college funding specialist as well. I know I keep saying that, but I'm a specialist in a lot of things. So I see parents doing this all the time where they almost put their retirement on pause because they want to help out with children. You probably want what's best for your kids, but this often includes helping them with college, right? So funding your retirement is much more important than funding your kids' college education. You should make sure that you are on track to retire on your own terms before you help paying for college. You can do a little bit, that's fine, but do not put your retirement on hold. They are going to college in order to get a good job so they can take care of themselves. It starts to become less of your responsibility. We're almost there. Home stretch, guys. Not reading the fine print, right? As we mentioned earlier, the calculation on credit card companies use is different for every company, but it's always in this fine print, right? This fine print will tell you what will happen if to your interest rate at certain points of time, or if certain actions are taken on your part. Spend time. I know it's not fun, but really understand the terms and conditions on some of these monthly statements that we're getting. There's a lot of fees that can be built into things that you might not know about that are very easily avoidable if you actually read the fine print. Most deals, when they sound too good to be true, are usually too good to be true if you read the fine print. Okay, number 50 here, making decisions based on emotions, right? Personal finances is one of the most emotional things that we're going to deal with in our lives. It's not always good, right? And it's very difficult sometimes to separate those emotions from the facts when we are trying to make financial decisions, right? So it's critical that we look at our finances objectively. That's why a lot of people hire people to do it with them or for them, because they don't have that emotional connection. So this is hard to do. I get it. But I'll point you back to number 38, getting professional financial advice. A financial professional can help you with an unbiased opinion about your finances. Number 51, lending money to friends and family. This is a personal decision. Whether you do or you don't, it's totally up to you. But please go into it with your eyes open. When you lend money to friends and family, there's a good chance that you're never going to get it back. Okay. You may also put your relationship with that person at risk. So I say if you're trying to lend money to friends and family, don't expect it back. Just personally, not saying anything about your friends and family, but it's just a weird thing that it always seems to go that way. Okay. Number 52, and this is our last one. And hugely part of why I do what I do, and we do talks at schools all the time for this stuff too, is not teaching children about money. By a show of hands, no, I can't see you all. But how many people here wish that their parents talked to them about some of this stuff, about budgeting, about how taxes work, about how savings work? So how many of you are now teaching your kids about those things? And if you're not, guess what? Going back to our plant a tree thing, start today. It's never too late. So we covered a lot. Thank you all so much for sticking around or just watching the recordings. I think we're kind of at time here, so I'm going to let everybody go. But, there's a lot of money mistakes that are out there. Just really focus on the main categories that we talked about today. If you have any questions at all, do not hesitate to reach out to me. Me and our team right now, we're kind of firing on all cylinders, helping people get prepared for 2025. Everybody that did register for this is eligible for a no-cost consultation. We are helping a lot of folks right now with the open enrollment decisions and benefit reviews. Okay, so there's a lot going on. I appreciate you spending this hour with me to bolster your financial education. I wish you all a happy fall, and I hope you stay warm out there, okay? You have a good one, and we'll talk to you soon. Bye now.